is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. Andrew, until recently, the bull market has been all about Bitcoin. We've seen Bitcoin rise above $100,000, driven by several different factors, including the influx of capital that has formed around DATs, digital asset treasury companies, and also around ETFs. In fact, it was the ETFs, I think, who helped Bitcoin ETFs reach the highest sort of level of assets of any ETF within its first year. They reached $10 billion quicker than the S&P 500 did, or the gold ETF did, by, I think, an order of magnitude. And I think a lot of this is driven largely by the perception of ETH as a store of value asset and as a medium of exchange. And in fact, if you read the Bitcoin white paper, it's e-cash, electronic cash, and this idea that, we could have an alternative currency to the fiat currency regime was one of the sort of founding principles of Bitcoin. But there's a whole other thing going on in the Bitcoin universe. And we've actually covered it on the show, I think probably more than most people have, which is that, Bitcoin is a store of value asset, digital gold, and so forth. But it's also the largest, most resilient, longest running, most secure blockchain network in the world. And so as a result is this really fertile ground, a platform, if you will, for all sorts of application development and the deployment of other assets that leverage Bitcoin's, tried and true security and scale. And there are some really interesting projects out there that are trying to unlock, I think, Bitcoin's potential. And it's pretty significant. Like Bitcoin today has got a $2 trillion or so market value. For it to get to $2 million per Bitcoin would imply about a $25 trillion market price. Now, that is comparable roughly with the market value of investable gold. But if you think of Bitcoin as a network or a platform that could support decentralized applications, other assets, RWAs, and so forth, the potential of that starts to look a lot bigger. So we've talked about this, we've danced around it a little bit, but now we're going to go deep. We've got a great guest today to talk about, Bitcoin Chapter 2 or Season 2, however you want to describe it, the renaissance of Bitcoin as a platform for much more than what it is so far. So we're very lucky to have David Tse, who's the co-founder of Babylon. Babylon is the infrastructure layer for Bitcoin and a self-custodial staking protocol that allows Bitcoin holders to earn rewards while maintaining full control of their assets. He's also a professor of electrical engineering at Stanford University, where his research spans information theory, wireless communication, machine learning, and blockchain infrastructure. David's a member of the U.S. National Academy of Engineering and a recipient of the Claude E. Shannon Award, the highest honor in information theory. He has authored over 200 research papers, holds more than 20 patents, and his co-authored textbook, Fundamentals of Wireless Communication, is used by universities around the world. In addition to his academic achievements, David serves as an advisor to Bain Capital Crypto, contributing decades of his technical insight to the next generation of decentralized systems. So, David, thank you very much and welcome to the show.
Alex, thanks for having me here.
So, David, with a pedigree like that, I only have one question. Are you Satoshi Nakamoto?
No.
That's exactly what Satoshi is, isn't it?
And I'll just leave it at
that. So, David, let's talk a little bit about Babylon and about staking on Bitcoin. So, people who listen to this podcast have been hopefully interested enough in crypto that they would know that, Bitcoin uses proof of work. There are miners, not pickaxe miners, but, miners who are adding computing power to secure this network. And then there's other systems like Ethereum and Solana that use this very different system called proof of stake. So how do you get staking onto the Bitcoin network? And why do it?
Yeah, so great question. So maybe just take one step back, right? You mentioned Bitcoin was first invented as an e-cash payment system. Then it became a store of value, which it is right now. But it is also a digital asset. And so Babylon's vision has always been how to make Bitcoin as a useful digital asset. And If you think about digital asset, right, the use of digital asset mostly is on smart contract in blockchains that support smart contract. But the biggest challenge here is that Bitcoin doesn't have smart contract. So how do you make Bitcoin useful? Well, the way to make it useful is to connect Bitcoin to the kind of the smart contract world. And Bitcoin staking is kind of our first product, which goes in that direction. So to explain a little bit more about Bitcoin staking, right? So we break it down in two terms, Bitcoin and staking. So Bitcoin itself is the proof of work network, right? So it's not secured by the Bitcoin asset. It's secured by, as you mentioned, the miners doing work. However, Bitcoin is also a digital asset. So now staking, on the other hand, is what happens in the proof of stake networks. Many of these smart contract chains are proof of stake networks like Ethereum or Solana or smaller ones like Cosmos, etc. So all these chains require asset to provide security. So you can think of the asset that provides security. These are like collateral. You put in some collateral, not unlike a house, and you use that collateral to secure a blockchain in this case. So our protocol is actually a very simple idea. And the idea is basically say, hey, since Bitcoin is like an over 2 trillion asset, why not use it as a collateral to secure proof of stake chains? So that's it. That's the high level idea. However, in a proof of stake chain, usually the security is done through smart contract, right? So for example, if you have a collateral, then you have to say, oh, if someone does something bad, I should be able to slash the asset. And that's usually done through a smart contract. But Bitcoin doesn't have a smart contract. And so the challenge, the technological challenge is how to enable such a smart contract like capability without smart contract on Bitcoin.
So how do you do it? How do you enable smart contract like capability without the smart contract?
Yeah. So what we realize is that Bitcoin doesn't have a smart contract. However, Bitcoin has a very simple scripting language, and this is a language that Nakamoto invented to describe Bitcoin as a payment system. Okay, payment system. Now, if you think about payment system, it's kind of like it supports only very few basic operations, but one very important one is the following, which is if someone present as a private key, then it can use the private key to sign and spend a Bitcoin. Okay. So therefore, to emulate the slashing behavior, we have to sort of emulate this ability to sign, and signing requires a secret, which is a private key. Okay. And so basically we emulate that using cryptography. If you think about cryptography, cryptography is best at keeping secret and revealing secret only under appropriate conditions. That's essentially what cryptography is good at doing. And so we are able to use cryptography to engineer such a system so that whenever there's a bad behavior on the proof of stake network, then a secret, a private key get leaked by whoever observing the system. And that someone, which is like a watchtower, can now use that private key to actually spend a fraction of that Bitcoin to enable the slashing functionality. So that's essentially the magic, the crypto magic that enables the technology to achieve slashing without smart contract.
How is it? Sorry,
And then
I don't want to go down the technical rabbit hole because I have a lot of big picture questions. But so in that context, you're only able to, like, a slashing is a penalty. It doesn't mean you forfeit everything. It means you forfeit some of it. And so in this case, it would be just a portion out of the same wallet address, or is it a separate wallet address?
Yes, exactly. So in Bitcoin, whenever you put a Bitcoin in a so-called UTXO, then you can say that, okay, a certain fraction of that Bitcoin, say 90% or 99%,
Yeah.
goes to somewhere, and another 0.1% or 1% goes to
Yeah.
somewhere else. And so we can use this capability to perform so-called partial slashing
Okay.
and not full slashing. So
Yeah.
this part is not that complicated because it just uses the basic Bitcoin spending functionality.
Okay. Andrew, you had a question there. Didn't mean to interrupt.
Yeah, sorry. And then what I'm curious is, so I understand you guys have kind of essentially figured out a way to bootstrap economic security that you can then use to secure, like, essentially chains and things like that. I guess, what did you guys build your own chain that's then secured by this stake, or what? Who are the customers of this, like, Bitcoin economic security?
Yeah, so yes, we built the first chain that is a customer of the Bitcoin security ourselves. So this is what I would call a dog food chain, eat our own dog food chain. So it's called Babylon Genesis. It has a much more elaborate name than dog food chain. We figured dog food chain may not be a good name for this blockchain, but maybe it would be. This is
It's
crypto
actually
after
a
all.
great
That's a good
name.
name
This
for
is
like
Great
crypto
name.
after all. This is
it's a
crypto
good
after
name for an
all.
NFT
So
project. If you do
yes,
an NFT dog food chain for that, I think people would actually they would eat it up.
right, but not for a Stanford professor's project, I guess. Yes. Anyway, so yeah, so right now we have the first chain, and then in October we will launch another bunch of new blockchains. Most of them are new blockchains. Some of them are existing blockchains, which have signed up to get this economic security. So the good thing about our technology is that almost independent of what is the underlying consensus stack that the blockchain uses, they can add this Bitcoin security in a modular fashion and get additional security from this Bitcoin staking. You know, a lot of blockchains already have their own consensus and they have their own validators. So they don't want to completely abandon that, but that's okay. You can get additional Bitcoin security. And this is sort of one way for these blockchains to get engagement with the Bitcoin community, is through getting the security. So I would
Yeah.
say there's an economic security aspect, but there's also a bit of a social aspect of aligning itself with the Bitcoin holders.
Yeah, so that makes sense. It's almost, in some respects, it kind of reminds me of like EigenLayer in a way, but for Bitcoin. It's like it allows you to, I guess, in the case of EigenLayer, you're restaking ETH, but whereas obviously like Bitcoin doesn't have native staking, and so this is essentially a way to earn a yield on your Bitcoin, and I guess the risk, you essentially have to take risk for doing that, because if you misbehave, or if you delegate, I'm assuming if you can kind of like delegate your stake to someone else as well, and if they misbehave, then your Bitcoin is effectively slashed or partially slashed. But then in return, you earn a yield, and that yield is essentially financed by a plethora of different. Are these kind of like EVM chains? Are they SVM? Like, I guess it could be any type of chain, I guess, really, is kind of
Yeah,
what you're saying, right?
so yes, that's right. So in fact, right now we have built this technology on top of three stacks. One is the Cosmos stacks. This is the first stack that we built because our dog food chain is actually a Cosmos chain.
Yeah.
And the second stack is Optimism Rollup, and the third stack is Arbitrum Rollup. And now you may think, why do these rollups need Bitcoin security? In fact, rollups often have already borrowed security, say from Ethereum, okay? But Ethereum security usually comes very slowly. Every 12 minutes, you get finality on Ethereum. So for these rollups, if you want to get fast finality and you don't want to just trust the sequencer, having Bitcoin staking will add to the fast finality security. And then you don't have to just trust the centralized sequencer. So therefore, some of these rollups offered to give a fraction of the sequencing fee to the Bitcoin stakers to get Bitcoin security.
Yeah, that makes sense. So, for example, I run a prediction market, Arbitrum Orbit L2. So, I'm pretty pretty familiar with this. I guess I'm curious. Typically, when you run kind of like an Arbitrum Orbit L2, you pay, typically it's somewhere between like 10 to 20% of sequencer fees to Arbitrum, And then you also have settlement fees, which are just kind of a straight gas cost, like Ethereum gas cost, which can be anywhere from fractions of an ETH to a couple ETH per month or more if your chain's seeing a lot of activity. And then there's also data availability fees, which if you're settling on top of Ethereum, it can be incredibly expensive. But most people are starting to use Celestia or maybe EigenLayer as well. So for you guys, would this I guess thinking about this logically, is this replace one of those sort of three different layers of cost for a layer 2, or is this almost like an additional cost, but in return it's like you're supercharging the sort of security of your L2?
Yeah, I would say it's orthogonal to data availability layers, and it's orthogonal to the settlement chain, which in this case is Ethereum, in your case of Orbit. I would say this is a cost that kind of replaces the need for going into a decentralized sequencer networks, right? So a lot of people say, okay, we have a centralized sequencer and they want to go to a decentralized sequencer network. That comes with cost. And with Bitcoin staking, you don't need to do that anymore because your security is now not entirely dependent on the sequencer, but also with the Bitcoin staking. So I would say that replaces the need to go to decentralized or shared sequencer networks.
Interesting. Yeah, and that's interesting too because most of these layer 2s are not, the sequencer is fully centralized. And a Bitcoin is the most decentralized network there possibly can be. So in a way, it allows you to go from like a fully centralized sequencer to, I guess the question I would have, again, just putting on my founder hat, would be, I guess, what does that cost look like in terms of the sequencer fees? And then also, for a lot of layer 2s, like their token essentially serves as like a staking plus gas token. Does that sort of, I guess, like, how does that sort of dynamic work? Or is this, I guess, essentially, again, just kind of replacing sort of the settlement and DA layer?
Yeah, so in terms of sequencing fees, we have already several agreements with Rollups, and sequencing fees that they are promising is roughly of the order of 10 to 15%. So comparable to the numbers that you were mentioning about paying to Arbitrum.
Interesting.
But in return,
Very
they
cool.
get Bitcoin staking. Yeah.
Yeah, that's interesting. And so the reason why I'm asking this is just that there's a lot of proof of stake networks that are almost inherently unsustainable. They are just purely financed through inflationary rewards. And so what's interesting about this is you guys are providing, a very tangible benefit, which is essentially like Bitcoin levels economic security, and then essentially, the revenue you're earning from that is going to these Bitcoin stakers who then, in a way, it's almost allowing you to, it allows you to earn like a fundamentally sustainable yield on your Bitcoin. So that's actually really interesting. Yeah.
Well,
Yeah, and actually one thing we found out, sorry, go ahead, Alex.
Well, I was going to say, so the yield that you're receiving by doing this is staking yield paid by other proof of stake networks who are paying you because you're adding staked assets to their network to enhance their security. So, I'm trying to think like, what's a good analogy to bring it back home? Like, people can compare Bitcoin to gold, and actually, like in a sort of pre-Bretton Woods world, gold is this inert object that is kind of inconvenient as a medium of exchange. It's very cumbersome and quite heavy, but it's incredibly important. And what happens is everyone builds financial institutions and paper money on top of gold. So you have notes that are promissory notes that allow you to redeem them for gold. You've got banks that lend against reserves that are based on gold and so forth. Anyway, I was reminded of this only because I think this is like, Bitcoin is digital gold, but actually it's sort of this foundational monetary layer that can add security and trust to the things that are built on top of it, which I think is really interesting because like when we talked to some folks last year during the beginning of the Bitcoin season 2 narrative, it was a lot about like kind of round square peg round hole, trying to build stuff on top of the Bitcoin network. Whereas I think this is leaning in directly into what Bitcoin's strengths are, which is that it's the largest, most decentralized, most resilient, longest running network with the biggest monetary base. How do you leverage this monetary base to make it useful for applications? So
Yeah.
rather than building applications like on Bitcoin, it's like using the stake to supercharge proof of stake networks. But the Bitcoin is still foundational to it. That's what I'm saying.
Yeah, I think you hit the nail right on the right place because Bitcoin is indeed like gold is very inconvenient as a payment system, right? Because
Yeah.
the network is very slow. The one block is every 10 minutes. Nowadays we're talking about sub-second confirmation on proof of stake networks like Solana and Sway. So this is very slow. It's very awkward to use on a day-to-day basis. However, it's actually perfect to do one thing, which is as a collateral.
Yeah.
Okay, because people and I think the right technical term is collateral because you're saying gold, you're using gold to back a certain financial system, and that's essentially what a collateral is that hey, I'm putting the collateral there to ensure that nothing wrong will happen. If something wrong, you
Yeah.
can take the collateral. It's like your house, and now you can. So essentially, this staking is like the first use case of Bitcoin, I think, as the collateral. And collateral is actually perfect for Bitcoin in a different way because nobody wants to sell the Bitcoin, right?
Yeah.
Because you're hoping it'll go to $1 million. However, it's sitting there and it's not useful. And a collateral is a perfect because you can keep the Bitcoin, you don't have to sell it, but at the same time you earn value, you get value out of it.
Exactly. Yeah, I think that's right.
Yeah. Yeah, that's interesting. I mean, it's in a lot of ways, it's kind of like the emergence of Bitcoin into, uh, I'm not sure if I would say replacing, but augmenting sort of what Ethereum's been working on in terms of scaling roadmap and things like that. I guess how do you see Ethereum in that context with like I guess in a world where Babylon becomes the main sort of economic security for layer twos and other chains. Where does that leave Ethereum in this sort of vision of the world?
Well, why couldn't you just
Yeah,
use Bitcoin? Why couldn't you just use the Bitcoin to support Ethereum and like extend its lead in terms of the asset base, the amount staked?
That's maybe
yeah.
an
So
add-on question as well. But
yeah, so definitely,
I'm bullish Ethereum, so anyway.
I want to hear the bear case.
yeah. So yeah, using Bitcoin to secure Ethereum is certainly possible. But there are certain, I think, from a purely economic point of view, economic security point of view, it makes sense. But there's a bit of an ideological conflict there because Ethereum is Ethereum, Bitcoin is Bitcoin. So in some sense, this world is still a little bit more, segregated in that sense. However, actually, there is one very important role that Ethereum and Bitcoin can work together through this kind of technology. So we talked about Bitcoin staking, right? So Bitcoin staking is offering collateral to secure a chain. Okay. So Bitcoin staking is actually operating at the chain level. You're securing the entire chain or entire rollup. So it's happening at the consensus level. But we just issued a white paper actually 2 weeks ago, which generalized this technology that we have to essentially provide Bitcoin as a collateral, not for the chain, but for many smart contract applications. So think about, say, suppose you want to use Bitcoin not to secure a chain, but to borrow some stable USDC. Okay, what do you have to do? You have to use the Bitcoin as a collateral also. So in fact, that use case is actually quite similar in structure to the Bitcoin staking use case. But now the engagement is Bitcoin with a smart contract. Okay, and where are these smart contracts? Well, a lot of them on Ethereum. And so, therefore, I think the engagement of Bitcoin with Ethereum is not necessarily through staking, but through such engagement with the smart contracts on Ethereum, the Aave and the Morpho and the Oilers of the world.
Yeah, that's interesting. That makes sense. I mean, you could almost imagine a world where there's like a new maker DAO, but it's just using Bitcoin purely as a collateral. And it's just like a Bitcoin backed stablecoin.
Yeah, Bitcoin backed stablecoin, Bitcoin backed lending, and Bitcoin backed whatever you want to use Bitcoin as a collateral for.
How can you just talk a little bit about how this is more secure than something like a wrapped, like WBTC, for example, which is like I think the main version of, I mean, again, version of Bitcoin on Ethereum. Just really quick, like what are the differences there?
Yeah, okay. So very important is that our technology, the main focus of our technology is trustlessness, okay? In other words, there is no third party involved. So if you think about smart contract, right? Smart contract is trustless. There's no third party running a smart contract, okay? And that's the beauty of a smart contract. That's the beauty of DeFi in general, actually, decentralized finance. Now, if you want to use Bitcoin with this smart contract and you want to go through WBTC or Coinbase BTC, okay, then you're going through a third party because somebody is issuing that wrap BTC, whether it's BitGo or Coinbase. And so you loses the trustlessness through that process. So our technology, because it's through cryptography, we're using cryptography to replace that third party, basically. Then Bitcoin can be directly connected to those smart contracts without a third party. And we're removing that third party. That's and that's, if you think about it, that's essentially what we did for staking, because we also could have built something which is you first get WBTC and you use WBTC to provide security to these proof of stake chains. But we did not because we didn't want to go through a third party bridging.
Yeah, that makes sense.
Yeah. Well,
Um,
it's really interesting because one of the superpowers of being a holder of a proof of stake asset is that you can earn this yield. And, in Bitcoin, like the native yield is paid to miners in the form of, inflation and certain transaction fees. So you can go and buy shares in a publicly traded miner, but that's pretty indirect exposure. So this is a way, and then the other alternative is, lending through like some centralized company and earning a yield that way, which is also not always a great idea, as we've seen in past cycles. So in other words, like this is a way to get like non-custodial native yield on Bitcoin without having to interact with some risky centralized entity, I guess, right? So it makes being a Bitcoin holder a lot more attractive as well. And that yield, I'm guessing, like at least initially, would have to be. I guess it depends on how much Bitcoin is staked, but and to what network, right? Because I was going to say initially, I thought maybe that would be low because any staking yield from these networks distributed over the whole Bitcoin network is de minimis, but it's not the whole Bitcoin network. It's anybody who elects to use this, right? Babylon, in other words. Like, so it's like if you opt in, then you're entitled to the yield, but otherwise you're not. Is that correct?
Yeah, so right now there are numbers. I can show you numbers. We have right now 6 billion, roughly 6 billion, 5.8. I checked the other day. Billion worth of Bitcoin, around 50,000 Bitcoin staked on the Babylon protocol. The yield that I checked a few days ago was about 0.5% APR, 0.5% APR. So those are the numbers that it seems
Yeah.
to make 50,000 Bitcoin happy. Now, I would like to make a point, which is that if you look at all these other applications, okay, it's not just necessarily Bitcoiners passively earning yield. So, for example, lending, right? You're using Bitcoin to back a protocol, which means that you're using Bitcoin to back your ability to borrow stable. Now, that's not just passively earning yield because that's getting stable liquidity, stable USDC, for example, for you to do things that you could not do with Bitcoin. So you can think about multiple use cases, some earning yield, some making your Bitcoin useful.
Yeah. Fascinating.
what do you think about? I think like one of the things that this is really interesting about as well is like the current market is, essentially being driven by digital asset treasuries. And there's a bit of a mania around these sort of digital asset treasuries around like, how do they increase their Bitcoin per share? And right now it's mostly around kind of like the financial engineering side. Whereas I think the true sort of long-term goal is for there to be, essentially a native like operational way to increase your Bitcoin per share, similar to like how the Ethereum digital asset treasuries, I would say right now have an advantage there because they can stake their ETH, they earn a yield, they get essentially a multiple on that, and it kind of like supercharges the whole process. Is that something you sort of foresee? I guess like I'm just kind of curious, what's the makeup of these suppliers of Bitcoin collateral? Is it more on like the individual side, or are you seeing some like institutions and sort of digital asset treasuries, if not lending Bitcoin, at least kind of interested in it?
Yeah, I can tell you, we have a live network, so I can give you some real data. So just last week, you can check all these things, it's public information. Just last week, around 7,000 Bitcoin was staked by Kraken. So Kraken, we know because, you can look at the network. We have these things called finality providers, which are basically like validators for Bitcoin staking. And Kraken has a finality provider, and suddenly we saw 7,000 Bitcoin, 7,000 or 10,000 Bitcoin. I think they told us that they want to stake a total of 10,000 Bitcoin. And I think so far they've staked 7 or 8,000 as of today. I didn't check in the past 2-3 days, but yeah. So institution, that's an example of an institution. There are also many individuals because there are over 200,000 or 300,000 stakers, individual stakers. So there are a lot of those with a very small amount. The median there is like, 0.005 Bitcoin. So that's our minimal, and a lot of people at the minimal. So we get a very wide range of stakers. Our network is completely permissionless. We don't know some of them who they are, but just look at this data, the numbers, and sometimes we do know. For example, Kraken gave us a heads up that hey, we're 10,000 Bitcoin coming in, guys. So, but we didn't ask for it. We just got a message one day.
Very cool. That's yeah, that's really cool. Yeah, that's interesting. Okay, and then I guess in the future, is there, again, you don't necessarily have to comment if not, but is there a way to like secure the network even more with like your own sort of Babylon token, or like how does that work? Do you guys kind of foresee this as being more of like a tokenless sort of crypto, like almost like middleware built on top of Bitcoin that sort of connects, like you said, Bitcoin stakers with kind of like other chains? Or how are you guys thinking of, I guess, of like the expansion of the vision around Babylon?
Yeah. The main vision of Babylon, right, is we want to create useful utility for Bitcoin holders. Okay. Right now, most Bitcoin holders have nothing to do with the Bitcoin. They have the Bitcoin sitting there, they don't know what to do with it. We want to create more interesting use cases, but in a trustless fashion without going through third party. So if we have more Bitcoin holders that can use their Bitcoin in a useful way, then we have succeeded. Okay. Now, how do you accrue value to baby holders? Of course, that's important as well. But important thing for us is first build a successful product. And you can imagine things like revenue, protocol fees, and so forth that can be generated from doing this kind of thing. So that's sort of where we are heading.
Yeah, great.
Yeah,
Well,
I
that's
think
exciting. I mean, to me, like this is the most credible and compelling, not credible, most compelling sort of explanation that I've seen for how Bitcoin can help to turbocharge innovation like in DeFi and other sort of areas that have typically been dominated by those smart contracting blockchains, and how the two kind of work almost symbiotically, where you're leveraging almost the shared security, which is a term they use in the Cosmos ecosystem, but in this case, we can use it to define by the sort of total asset base and the resilience of Bitcoin to secure and support innovation across many different networks. To me,
something very bizarre, right? If you go to like Morpho or go to Aave, okay,
yeah,
and there's a list of collaterals. There's a list of collaterals there, but there's no one collateral called native Bitcoin. Okay,
yeah,
there's none. And yet, that's a 2.4 trillion asset sitting there. So it's very weird, right? If you think about it. And we want to change that world. I think that's what we are after.
Yeah. I love it. Well, listen, this has been such a fascinating conversation, David. We really appreciate it. And I apologize for not being on video. I'm calling in from rural New Brunswick, Canada. But they don't have high speed, let alone smart contracts on Bitcoin. But it was
Hey, don't make fun of Canadians. I'm a Canadian, actually.
So am I. I'm at my own cottage. I choose this life. This life didn't choose me. Well, maybe it did. But anyway, it was a great discussion. Thank you so much. Really enlightening, technical, but for me at least, as a non-technical person, very digestible. I think our listeners will have gathered a lot from that. So thanks for joining us. That's it for this week's episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. That's David Tse from Babylon. Make sure to like, share, and subscribe to the podcast. It helps other people find it. Until next week, take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.